Hi, this is Ollie and welcome back to Make Money Trading. And this is a broadcast session I'm recording on the 10th of June 2020, and this is a follow-up video to last week, and this is how to play 2020, the year 2020, part 2. So as I said last week, there is an ongoing tug of war between the fundamental risks of unemployment, debt, falling earnings, restricted travel, huge earning shocks to travel tourism and related companies, and uncertainty. There's a tug of war between that and the fund flows into equities because of economic stimulus and low stimulus rates, and I talked about that in some detail last week. So since the video last week, equity indexes have continued to move up strongly. And in fact, the Nasdaq has gone to a new all-time high, which I said was likely last week, and it has actually done that. And on the 22nd of May, there was a rare bullish signal in the Nasdaq. Let's go and have a look at those two things. So here we have, up in here, price has gone to a new high. There was the previous high, and it's gone higher, significantly higher in the last 3 trading days. Here is the Golden Cross, where you can research this if you like. The Golden Cross is when the 50-day moving average crosses up over the 200-day moving average, and that's what we've got here. And it's a bullish signal, which doesn't happen all that often. In fact, the last time that it happened was way back in April 2019, where we had this cross, the red line going up over the green. So we've got another bullish signal. Well, we actually had it back on the 22nd of May, but we've got two bullish things going on, a new high and this Golden Cross. Well, many things, but that's 2 of them. And I also watched the signals from the brilliant technical analyst Marty Zweig, who wrote this brilliant book, which I thoroughly recommend you grab from the library or Amazon or wherever else you can. Well, the library's probably not as good because I write all through my books and make notes on them and use them over and over and over again, so I would recommend buying this book. It's pretty cheap. Martin Zweig's Winning on Wall Street. It's quite technical. We've got some brilliant stuff. The reason I mention it is that he has a number of indicators that I follow and I update on my spreadsheet, and they are all bullish at the moment, and I tend to follow when he's bullish, when his signals are bullish, which they all are at the moment. So more bullish signals. And because stocks are racing higher, so are other risk assets that are highly correlated to stocks. And if you do some correlation analysis, you'll find that these instruments are amongst the highest correlations, historically above 90% correlation with stocks. So let's go through them. Let's have a look first at Aussie USD. So here we are looking at Aussie USD. This is a really interesting chart for me. You can see that as stocks plummeted, Aussie USD also plummeted. That's why it's highly correlated. It moves in the same direction at a very similar speed and correlation to stocks. And of course, the rising up of stocks has coincided with the rise in Aussie USD. One of the things I'm really interested in, though, is it has come up to this previous level of resistance, come right up to it and backed right off it. This is a daily chart, and had a go at getting through and backed off it. If it breaks up through there, it's a bullish sign. If it stays below there, it's a bearish sign. So I'm keeping my eyes open to see what happens there. Okay, here's Aussie Yen, and we've got exactly the same situation because, as I said, highly correlated with stocks. Aussie Yen has fallen as stocks have fallen and has gone up as stocks have gone up. And again, it's interestingly hit another level of resistance, and same as Aussie USD, it's fallen off that level and currently is well below. So I'm watching that as well. Now, the reason I'm talking about these correlated instruments is that if you have a view on equities, or the fact that you think the world economy is going to rebound, or things are going to be good or better than expected, and you're expecting equities to go up, you don't necessarily have to take an equity position or a stock position. You can, and some people like to take currency positions. Well, I'm showing you how you could have taken a currency position on the way down as things were bearish, and back on the way up as things were bullish in the stock market. So you can use, if you prefer, highly correlated currency positions to express your view in the market. Okay, here we're looking at NZD, USD, same thing, highly correlated. Stocks fell, Kiwi USD fell, stocks went up, NZD USD went up, hasn't gone up as high as Aussie, and hasn't hit anywhere near this level of resistance yet. So that's not as bullish, but it's still doing the same thing. And here is Kiwi Yen showing much the same. There is possibly, I've just noticed, a possible area of resistance there. We see we've got 1, 2, 3 times that it's hit that level and been resistance, and now we've come up and just had a go at going above that level of resistance and backed off again. So interestingly, currencies are saying a slightly different story than equities. Perhaps there's a little bit more caution in the currency market than the equity market about just how long and strong this equity market can be. But let's just see. If it breaks above there, then I'd be bullish. If it stays down below here, I'll be bearish on Kiwi Yen. And here is Euro Yen. It is not nearly as clear, and the correlation has not been nearly as good. We have had a fall in Euro Yen as stocks fell, but nowhere near as pronounced as Aussie and Kiwi. And we have had a big gain in Euro Yen as stocks have rebounded. And actually we've gone up to a new high for the year in Euro Yen, but then we have rejected that level, temporarily at least, and below again this level of support and resistance. And moving on finally in our related instruments search to copper, and we can see a big fall in copper early on in the year. This is the fall which correlates and is closely related to the fall in stocks, and here is the rise in stocks. And interestingly again, we're coming up to a level of support and resistance which has been on both sides. Let's find a place to put it. Probably needs to be a bit lower than that. There we are. I found where it's here, it's support, and here it's resistance. And it'd be interesting to see what happens when price gets up to there, because that's been support and resistance in the past, and it may well stop at that level before it breaks through, or in fact stops and comes down again. But again, correlated instrument, another way to trade this move. Okay, some interesting questions for you to think about. Question 1, is it easy to make money in the markets consistently? Well, I hope you know the answer is no. If you don't know it, I can tell you that it's because you've been trading the markets for less than 3 years. If you answered yes to that question, it's because you haven't had much time in the markets. Of all the things I've ever done, including starting businesses, buying and selling real estate, being involved in the corporate world, all kinds of things, of all of those things, by far the hardest way to make money consistently is in the financial markets, in the money markets. So it's not easy to make money consistently. Yes, it's easy to make money at times, but consistently month after month after month, no, it's the hardest thing I know how to do. Question 2, is following the crowd the best way to make money in the markets? Well, I hope you also know the answer to that question is no, because if all you had to do was follow the crowd to make money, then the crowd would be rich. And we know for sure by looking around us and looking at financial commentaries and discussions and everything else, the rest of the crowd, the followers, the people, the general mass of the population are not rich. So following the crowd is not the best way to make money in the markets in the long term. Sometimes it can be, not necessarily. And The next question, question 3, is buying stocks and correlated assets an easy, one-way, surefire way to make money right now? The answer is absolutely no. There is no such thing as a one-way, surefire way to make money in any market or situation. Yes, the bulls are in control and the markets are moving up, but there is no close your eyes, let's just do this way to make money. I'm sure nobody on this course is thinking like that, but if your brain is inkling in that direction, stamp it out, because there is no easy money to be made closing your eyes and just buying equities and stocks right now. So the reason why is that there are lots of other things going on than what we've talked about in last week's video and so far today. Let's have a look at the other side of the argument, and I'll explain why I am cautious and sticking to just 4 long equity positions right now. I could go to the charts and find opportunities in new highs and bullish stocks, and I could easily add 20 more positions. But I'm not doing that, and here is some of the reasons why. Okay, the first is something that I hope you hold on to and maybe even copy these slides, the incredible 6-month phenomenon. And the reason why I hope you hold on to this is because it's going to serve you for years and years to come. From the period 1950 to 2014, and if you took it on to 2020, I haven't done the calculations, you'll find similar, but we're talking about a very long period of time. That's a 65-year period. But in that 65-year period, for the consecutive months from November to April, the Dow gained 17,883 points. However, in that same 65-year period, but for the 6 consecutive months from May to October, the Dow lost 1,066 points. So yes, there is a huge negative stock bias in the 6 months from May to October compared to the other 6 months of the year. So let me put it another way. If you started on 1 November 1950 with $10,000 and only invested in the Dow from 1 November to 31 April each year, right now you'd have a gain of $973,639. But if you started on May 1950, i.e. you did the other 6 months and only invested in the Dow from May to October, right now you'd have a loss of $134. So a difference of about $1 million. And all you did was close your eyes and buy in the best 6 months of the year and not own in the bad 6 months of the year. And right now we're in the early part of the most bearish, i.e. the bad 6 months of the trading year. Now, of course, that's historically. That's over a very long period of time. It does not mean that any one year is going to yield that difference. But over a very long period of time, there is a bearish bias to the 6 months that we are in right now, going from May of this year to October of this year. Some more stuff which is making me cautious. News out this week. A new forecast from the World Bank predicts the global economy will contract this year by 5.2%, and the declines will be more widespread than at any time in the last 150 years. So the world is not in growth mode, it's in contraction mode, and it's the worst in 150 years. Not ideally what you'd expect as a time for equities to be rallying. More news this week. The World Health Organization this week said that the coronavirus outbreak is worsening, and more than 100,000 new cases have been reported in 9 of the past 10 days. Now, the reason we don't think like that is because we are part of the Western world, most of us on this course, and the Western media is trumpeting the fact that cases are lower in the US, Europe, and the UK. But, of course, that's only the Western world. If you look at South America and Africa and Asia, then the virus outbreak is worsening. So overall, across the world, the virus outbreak is not under control, it's actually getting worse. And you're welcome to read it down here at bbc.com. I've given you the link. On to US unemployment. Both Forbes and CBS News and others say that the US headline unemployment rate, which was given last Friday, which caused a bump and an upward surge in the market, is now at 13.3% as of last Friday, but that's actually a low figure and is likely considerably higher than the official tally suggests. But even if it was 13.3%, it's the worst number since records first started being kept in 1948. So you may have seen the unemployment numbers come out last Friday. They weren't as bad as expected, but nevertheless, they're the worst since records have started. Unemployment is bad in the US, and of course it's bad in the UK and Europe, and in fact it's probably worse than the numbers suggest because of different reporting measures. And when you've got people who are unemployed, they've got less money coming in, they're buying less stuff, they're less likely to pay their credit card bills, they're less likely to pay their debts. And when you're talking about this kind of numbers, these huge kind of numbers, that is a huge draw of money away from people producing goods and services. The other side of the other point is that the US government is having to pay unemployment benefits to these people, so billions and billions of dollars is going out. And the third part is that these people who were in employment and paying taxes are no longer employed and paying taxes, so the tax take from these countries, the US, Europe and the UK, is also down. So putting all this together, high unemployment numbers are bad and not something that you would expect to drive equity prices higher. On to trading legend Jeremy Grantham, who's been in the markets for about 60 odd years, said recently, the current market seems lost in one-sided optimism, which of course is what I'm suggesting you don't get into. He goes on to say, when prudence and patience seem much more appropriate. And his firm GMO is slashing its exposure to equities. Grantham goes on to say, we've never lived in a period where the future was so uncertain. The key here is uncertainty, which in some ways seems the highest in my experience. And he's talking about 60 years in the markets. The legendary money manager who co-founded Boston-based GMO and its long-term investment strategist said that the price-to-earnings ratio for stocks is now in the top 10% historically, while the US economy is in the worst 10% or perhaps the worst 1%. And Grantham says that is apparently one of the most impressive mismatches in history. Read as you will and research in your own time. And last week, Citigroup said that the financial markets were way ahead of reality with tougher times to come, warning their corporate clients that they should raise as much money as possible as they could before the pandemic's true cost is factored in by investors. Phew. So, I am long equities, but I am cautious. Also, as I said, my exposure is light compared to how I would normally trade when there wasn't all this uncertainty and all of this negative stuff with COVID still in the system and not really being accepted as a risk as much as it should by the equity markets. In my view, the greatest risk is being complacent and loading up on equities and risk assets, because when the sentiment turns, the market will turn very quickly. Happy trading as always, and please let me know what you are seeing in the markets. Take care.